Stay tuned for Retire Your Way with Dale Soutas, a leading financial retirement strategist and the founder of Soutas Financial and Insurance Solutions, right here in Fresno. Every week, Dale discusses pressing financial topics of the week, ranging from reliable income strategies to our financial markets, including Social Security, tax strategies, wealth management, RMDs, legacy planning, long-term care solutions, and most importantly, how to make sure you have enough guaranteed lifetime income to retire your way with choice and dignity. From taxes to trends to total transparency, Dale covers it all. And now, here is Retire Your Way and Dale Soutas. This is Retire Your Way with Dale Soutas of Soutas Financial right here in California. When you reach out to the phone number, we can get you started on your own no-cost written financial plan with the man himself, Dale Soutas, founder of Soutas Financial. 833-856-1382 is that phone number to call. I'll keep reminding you throughout today's program. Mr. Dale Soutas, you and Mo all trying to get us started right now. How are you doing this week?
We are doing great. How are you, Spike?
Good. Busy here and a lot going on. I'm going to ask you about later in today's program, are we going through a financial reset with our stock markets? We're looking at about 8 or 9% compression right now. Maybe that's in part to the war that we have going on, or is that just other economic factors that we've been waiting to have happen for a couple of years, and now they're finally coming to fruition? What's going to happen with interest rates as well? But I always really enjoy kicking off with the stories of folks you were helping. We're getting through tax season right now, coming through that, unless you filed an extension, which I guess is okay as well. But I know that we always talk about Roth conversions, helping people out tax-wise, but who did you actually help with a tax strategy? Let's start out with folks on the front lines for you.
Well, yeah, that's a good question because this wasn't or isn't going to be something for last year. It's really something that's helping them this year and ongoing. There's a couple, they're east of Clovis out in the country in their early 70s. He retired last year, and they mainly right now just have Social Security incomes. So because the new year is here with only Social Security and not with the wages on top of that, we were able to calculate to take out a portion of money, a chunk of money from his IRA, or maybe her IRA, we haven't decided which is all tax deferred. It's taxable. We couldn't really do this last year in a big lump. We would have pushed him into the 22% bracket, maybe even higher, but we're able to pull out a chunk and eliminate some debt. And sometimes, when we get to retirement, we don't have everything paid off. And it's not like you have to have your house paid off. That's built into your plan, and eventually it might get paid off while you're retired. But if a person has maybe credit card debt, or maybe they have solar, or they have a home equity line of credit or whatever, in this case, they had some debt, and we wanted to take a chunk out of that IRA that's taxable to eliminate about $1,500 or more of what they had to pay out in monthly payments to cover that debt, let's say. But we're doing it in such a way that it'll keep them in the 12% bracket, so keep them from really pushing their income too high. But it's also going to help their plan, their income plan, which is something we were looking at even prior when we set up their plan, is how do we eliminate the debt? Or yeah, it'd be nice to eliminate death too. Anyway, but the point is how to make it easier to be retired, have more money than to goof off and do the things they really want to do. So this is also, in future years will allow us to do more with the Roth conversions because they don't have the higher wages on top of their income in retirement. So it's a good example of using the tax laws right now, plus they both get the extra $6,000 each tax deduction because they're 65 and above. So that's helping us to more wiggle room to get Uncle Sam out of more of that retirement money, and or in this case, pay lower taxes and get rid of, some debt that they've had.
When talking to them about doing Roth conversions, taking more money out of your tax deferred accounts, paying the tax on it now to get Uncle Sam out of your accounts. He's a partner in our accounts that none of us asked for, but we all have to pay for, right? Was it hard to convince them? Does anybody ever look at you and go, wait a minute, why would you want me to pay more taxes right now? Can't I just keep waiting as long as I can and I'll find out in April, as people do, how much they owe in taxes? Is it
Oh,
hard to
yeah,
have
good
is it hard
question.
to have the conversation?
No, it's not necessarily hard. It just when people see, the long-term benefit of getting, paying the taxes today
Mhm.
at the low tax rates, and in these cases, many times I have married couples, so they're in the very low tax rates compared to if one of them passes away, then they're going to be in the high single tax rate. So it won't take as much income to push into the higher, 22, 24% brackets. So getting Uncle Sam out of some of that money or all of it, if possible, is very smart. And when they see that, they understand it's going to sting to, have to pay some taxes even if we strategize over a few years, it's going to sting paying that chunk of money. But it's better than, like I liken it to that Band Aid. How do you like taking your Band Aids off? Nice and slow so it hurts for a long time? Or do you just rip it off and it stings and you're over it? So get Uncle Sam out of your money, out of your retirement savings as fast as you can. It might sting, but again, we're at what? Um, the third lowest
Mhm.
tax rates in U.S. history. So take advantage now while taxes are on sale and do what you can. And that really, the wonderful thing is then down the road, you don't have to take RMDs, required minimum distributions from those accounts. Um, the money and the growth, sometimes you don't realize the growth on that money is also tax free.
Mhm.
So you convert 100,000 to Roth, it grows to 150,000. You have 150,000 of money that's tax free to play with. It's not tax deferred anymore. So
Yeah.
there's once they understand the whole picture, it makes it easier to take the sting, take a little pain.
Yeah, and I'm going to talk a little bit more about those tax brackets. If you don't have a financial advisory team that is talking to you about all of these elements, you're not getting the complete picture. You have your investment returns, but you also have the importance of your tax returns, and those taxes get more complicated as we move into our retirement years. Once we turn on that Social Security, once eventually we get to RMDs, required minimum distributions, if you continue to let your investments grow, your tax consequences continue to get higher as well. And what we're talking about here is maybe stopping the portion of growth on some of the taxes of your investments now. If you'd like to know what that looks like for you, if you're getting a little lost in the weeds, or if you're driving around doing your errands, say, I want somebody to do it for me, call the phone number or have your passenger take this number down. We'll do your tax and portfolio review. 833-856-1382 is the phone number. That's 833-856-1382. Or you can schedule your own time at Dale's website, Soutas.com, Soutas.com. Dale, since you said 22% tax bracket on this couple, I just pulled up the tax bracket. I think this is a part that people forget. Well, first of all, taxes are progressive. You helped me out with that a few weeks ago. I'm like, you don't pay 22% on everything. It's progressive
Correct.
to the point where you get there. But there is also room in your tax bracket. The 22% alone for, I just pulled up married filers, is 96,000. It's 96,951, essentially 97,000.
Yeah. To stay in the 12, you got to be under that 96.5
Yeah,
roughly,
if you want to
right?
be, under 12. Okay. Or 22 goes up to 96 and it goes all the way up to 206,000, meaning there's
Correct.
over $100,000 worth of room. So if you're married filing and what your total married filing is let's say, I don't know, 110, 120, you've got a lot of room in there where you can pay the taxes and stay at the same tax rate and get it over with.
Let's throw something else out in
Sure.
there. See, to stay for this couple to stay in the 12%,
Hmm.
stay under the 96,000
Oh, okay.
roughly.
Yeah.
Keep in mind, take 96,000, add the standard deduction for a married couple, 32,000
Yep.
200. They're both 65 and above, so they get an extra 6,000.
A
Okay,
piece. So it's 12.
a piece,
Yeah.
and then they get another 1,650 each, so that's 3,300. So you got 32, 35, and 40. What in my head? You got
Well, I think we're close to
about
$40,000.
50,000.
Yeah, for a
Over
married couple
40,000.
filing jointly, you got over $50,000 worth of deductions, close to. And if you're not taking advantage of it, you're leaving money on the table. Dale, I want to continue that thought. I appreciate that you brought that up. That does make sense. It's not just
That's how we're able to bring them under the down
Yeah.
to the 12%.
to keep yourself in, let's say, a 12% effective tax rate. Married filing jointly 96.9, or let's just call it 97,000. You want to stay underneath that. You're going to have married filing jointly. I mean, at married filing jointly, you already have over $30,000 of regular deduction. Is close to 15.5 per person. So you add those two together, we're at 32. The 12 for those over the age of 65.
It's 47,500.
Yeah.
Just standard deduction.
Standard deduction. If you are unclear, and then why we're talking about doing Roth conversions, it's like, look, we've got 3, 4, 5 years of these tax efficient windows right now. They're going to go away. You're hopefully going to live a long retirement, and then eventually you're going to have to start taking that money out at RMD. So why not start doing some tax strategies right now? Call the phone number, folks. Let's do your tax review. 833-856-1382. That's 833-856-1382. You can sit down with Dale. We can talk about it over the phone. I'm sure you have an idea of your tax brackets and how much income you were taking in. If you want to start over the phone, that's totally fine as well. Don't go anywhere. More Retire Your Way with Dale Soutas right after this.
Do you know how much you might be paying in fees within your retirement accounts? Just 1 or 2% in hidden fees can eat into your savings and potentially hinder your ability to achieve your retirement goals. But how do you know if you're currently paying these hidden fees, and how do you find them? Dale Soutas and the team at Soutas Financial can help you find the fees within your investments and explore solutions designed to assist with minimizing them. Take control of your retirement savings so that you can work towards keeping more of your hard-earned money. Call for your very own complimentary Retire Your Way review and fee finder report. Let us help work towards finding, exposing, and helping to eliminate those potential hidden fees for you. Call Dale Soutas and Soutas Financial today for your complimentary fee review. 833-856-1382. That's 833-856-1382.
Call Dale Soutas and Soutas Financial and Insurance Solutions right now to receive your complimentary tax map with your retirement readiness review. Learn multiple strategies that could protect you from higher taxes now and in the future. Taxes are a threat to your financial stability in retirement, so help protect yourself from the potential threat of rising taxes. Call Dale Soutas and the team at Soutas Financial to receive your complimentary tax map and retirement readiness review. 833-856-1382. Their team will help you navigate the financial waters to pursue your retirement goals. They offer inclusive retirement services such as investment directives for your portfolio, income-producing strategies, and wealth preservation plans for your family and legacy. Call Dale Soutas and the team of Soutas Financial and Insurance Solutions, 833-856-1382 right now for your retirement readiness review, and also receive your complimentary tax map. Strategies to help you keep more of what you've saved in retirement. Or write us at the email address dale@soutas.com. Welcome back to Retire Your Way with Dale Soutas of Soutas Financial. You know, even though we came through tax season, it's amazing sometimes that even people, let's just say in our own industry, the small pieces of incorrect information they have. Very quick though, on the break there, our producer was saying that. So we do talk about married filing jointly a lot. I just want to bring up for solo filers, the beginning of the 22% tax bracket is $48,004, and that goes all the way up to $103,000. So that's total income. It could include, your Social Security, which you're taking out from IRAs, or your TSP, 401ks, but at
Pensions, rental
48
income.
punches, everything. But don't forget, what were the deductions then for Single
Yeah.
filers?
So a single person, here's the fun. Single person for this year, it's 16,100 plus if they're 65 and above, they get the additional 6,000. And I think the other individual amount is a little over 2,000. So there's a little over 24,000 standard
Wow.
deductions, let's pluralize.
Hmm.
Now, let's say to keep them under that 40, what was it, 48?
48.4. Yeah, 48,000.
Yeah,
We'll just call
48
it for that for
for,
now.
okay, say 48. So if you do the 48, they can have 72,000 in adjusted gross income or gross income. But what many people don't realize is not all of your Social Security is taxable. So it doesn't, when you calculate your Social Security, not all of it is going towards that 72,000 or the
Hmm.
other amount for married couples.
Yeah.
So maybe 85% of it, if we're pushing the envelope a little bit, that's fine. But then you have the 72,000 that gross income,
Hmm.
and still pay 12% as a single person.
Yeah.
And there's many singles that have way over that, and okay, that's a good problem. You got money to spend. Sometimes paying taxes isn't necessarily a bad thing. It just means you're doing well, you're making money, and so on. But where you can do things to lower your future taxes, that's where we like to jump in and just do the math with you, with your CPA, with our CPA if needed, whatever, and just see, does it make sense to make changes now and lower your taxes in the future? That's the main point.
Hmm.
But sometimes people think, like you're saying, there's somebody we recently talked to who is, let's say, in the tax financial services business, and they had a question: why would you do a Roth conversion? You're going to have to pay tax on it down the road anyway. Again, what might tax rates be down the road?
Hmm.
Are they going to be the same 5, 10 years or more? Likely not. They're going to go back. I mean, the changes Trump made originally back that started in 2018 were to be temporary. He extended them, but that doesn't mean any new administration down the road can't, change them back upward. And on a practical side, why would we even say that? Well, the national debt isn't 38 trillion. The real debt is over 200 trillion because the 38 trillion
Boy, you
doesn't
really know how to
include.
relax our listeners, Dale.
Yeah, yeah, yeah. So don't run into that
Don't run
car.
to that car in front of you.
Don't go- yeah, and don't drive into that store. Okay, but anyway, so the reason it's over 200 something trillion is because the 38 trillion doesn't include their unfunded liabilities. So likely they have to do something to raise more revenue. They can't just keep hitting the button and raising their debt limit. Even though it's convenient for them to do, but eventually they have to do something. So not all of it has to be just income taxes. There's other ways to raise revenue, but to think it's going to stay this low indefinitely is not thinking it through.
We like to collect some notes from around the office and different meetings, and this one we're calling misinformation.
Hmm.
And
Misinformation. Yeah.
you know what? There's so many folks out there that are trying so really hard to understand their accounts and their investments and what they're supposed to do. And sometimes they have an understanding or a misunderstanding of something, and we really don't know actually where it came from. We had a guy, mid-50s, who was in the office, and he thought he can't withdraw from a 401k until he turns 65. Truth or misinformation?
Well, that's misinformation, and so the wonderful thing was, in talking to this person, they were excited because they're not even 59 and a half yet. Okay, they're like 50, let's say 55, and thinking, when they found out that yes, you can start drawing from your 401k, your IRAs, your tax deferred money as early as 59 and a half, then it was like, oh, wow. So that person actually went in and said, well, I'm going to retire, 59 and a half. But not that you have to, but that was kind of encouraging or helpful for that person. And I know my notes didn't say he or she, but it's not a he, it was a she. A wonderful
Hmm.
conversation with her I had. But the other thing is, people don't understand is that you can actually start taking from your retirement accounts even prior to 59 and a half using a special IRS rule. I think it's called the 72T. And as long as you structure it properly and you follow IRS rules, you can take money out before age 59 and a half without the 10% penalty. So again, there's many things that,
How
people.
and why is that? Is that a disability thing, or is that a need for it, or is that just saying I'm going to go ahead and pay my taxes? I'm retiring. I've saved enough. How are you allowed to do that?
Yeah, it's you have to structure it in such a way that you're taking equal payments over at least a minimum of 5 years. That's my rough definition of it. But yes, bottom line, they can, without even being disabled, start taking, let's say you've saved 1 million or 2 million or more and in your tax deferred accounts, and you would love to stop working and go on doing more fun things, then let us show you how to do that. Again, without having to pay the extra 10% penalty, you'll have to pay tax on that money you take out, but
Hmm.
you won't have that penalty, um, which is unnecessary if you do it right. So
Yeah, and I guess if you do it correctly with the 72T, as I'm reading here, that you're gonna kind of set it based on what is your life expectancy, and then what you're going to withdraw from those accounts and pay taxes on. Pretty much going to set it for life. So
not
as long as you start to schedule
not
it.
I mean, you have to initially have it set up that way, but from
Hmm.
talking to my CPAs, they point out, no, once you get past that 59 and a half and such, you can have it restructured at times. So that's something that
Oh, okay.
individually we'd have to look at and
Yeah.
decide, does it make sense to do or not.
So what about as well having information or misinformation? What about why even do these Roth conversions? You're going to pay the tax on this stuff anyway. You started talking about it a few minutes ago, but I was
Yeah.
thinking about them like, well, yeah, why are you getting me to pay my taxes earlier?
Well, again, tax rates are lower now. Okay, even if they stayed the same, um, basically, I mean, if they stayed the same, but your income increases, you could be pushing that, what you take out of your retirement accounts into higher brackets. Plus, taking just the minimum distribution, that percentage increases as you age. Each year you get older, that you have to take a higher and higher percentage. And if that money grows, you're taking out more. But the other concern people have had, I've had somebody recently say, well, yeah, but if I convert it, I still down the road have to pay tax on the growth, which is incorrect. So you convert
Mm.
100,000 to Roth and it grows to 50,000. You're not, along the way, you are not getting a 1099 to have to report the growth and pay tax on it annually. No, nor down the road, if you close the whole 150,000, all of it's tax free. So, that was some misinformation out there. So,
Mhm.
and
Mhm.
again, many people when they retire may be married, and they, might leave their spouse single in the higher tax brackets. So there's a lot of reasons, but not everybody needs to do it. So we look at it on an individual basis. We coach people individually based on their whole picture.
Yeah. Folks, you can call the phone number. Let's figure out exactly where you are at with taxes. You might have, even if you think you absolutely know how the tax rules work on all of your investment accounts, your retirement accounts, wouldn't you like a second opinion to be absolutely certain? Because what you sometimes think you understand is a bit of misinformation you've got from floating around either from the internet or from the water cooler or from the coffee break room. Let's find out the true facts for you. You can do that right now by calling the phone number. Let's do your complete portfolio and tax review with Dale Soutas and the team here of Retire Your Way. No cost to you, California. 833-856-1382 is the phone number for you to call. That's 833-856-1382. More with Dale Soutas right after this.
Are you worried that you waited too late to start your retirement planning? That you waited too late to start saving? At Soutas Financial, we believe it's never too late to start planning for your future. We can help you develop a personalized retirement plan that is tailored to your current needs and goals. The team at Soutas Financial will sit down with you and provide an evaluation of your current path, including your investment strategy, tax planning, and risk management approach. We'll help you identify potential areas for improvement and work with you to create a retirement plan that is designed to help you work towards having financial security and peace of mind in retirement. It's not too late for you to get started with Soutas Financial. Call us today to schedule your complimentary retirement planning session. We believe we can help you get on the path to financial security and peace of mind in retirement. Call Dale Soutas and the team at Soutas Financial to get started on your own complimentary written financial plan. Call 833-856-1382. That's 833-856-1382.
In your retirement spending plan, which accounts do you take from first to pay your monthly expenses? Your 401ks, 403bs, or 457s, or your IRAs, or your Roth accounts, investment, or savings accounts? Do you turn on your Social Security right away or delay? Do you use the growth from your mutual funds, ETFs, or bond funds first? Did you sell your business to create income, or do you have life insurance or annuity options? Or what about using HSAs for medical costs? Are you unclear if you have a retirement income strategy at all? You have accumulated assets for retirement for years. Now you need an efficient strategy to make certain these assets work together and last as long as you need them to. Call Dale Soutas of Retire Your Way and Soutas Financial for your own complimentary written income plan right away. 833-856-1382. That's 833-856-1382. Or you can write Dale at dale@soutas.com, SOUTAS.com. Welcome back to Retire Your Way with Dale Soutas of Soutas Financial. For you here in California, to get started on your own complete retirement plan, very, very simple. You can go to the website and schedule your own time right now at Soutas.com, SOUTAS.com, so you can sit down with financial advisor Dale Soutas. Or you can call our phone number, 833-856-1382. Folks are standing by right now to schedule a time for you. You know, we get this question a lot. You get this question a lot. People come to your live events, and it seems quite simple. But it's, are we going to be okay? Did we make the right decisions? And while that sounds simple enough, some people do just want a confirmation if they're going to be okay. But, you know, when you're unwinding that, you know, with couples, individuals, can you sometimes undo decisions that they've already made?
Well, sometimes they can, but, you know, the question mainly comes in all the time is, you know, whether they've had somebody formally set up a plan for them, which is kind of rare. I've yet to have anybody walk in with their written financial retirement income plan, but a lot of them have, you know, their different accounts. They've done their little homework on their own. Whether you've had a professional look at it or not, whether you've done it yourself or not, many people just say, is our plan sound? Does it look like, you know, we're on the right track so that our money will last, our income will last, and so on. And, you know, I had somebody recently in their mid-60s. He actually started Social Security early, in my opinion. He didn't wait till 67. He's, I think, only maybe 64. He retired. She's still working.
And how did you feel about him turning it on early?
Well, my initial thought was, my knee-jerk initially, I was thinking in my head, well, he could pay it back and have it delay and increase, because it hadn't been 12 months yet that he's received his Social Security, started receiving Social Security. So, you know, if you've started it early, different than a lady we talked about a few months ago, she had started it early, but she had gone past the 12-month mark, and because her high income, she's going to lose some of that Social Security back to Uncle Sam. But in his case, he's not planning to work anymore, which is fine. He's, you know, he might want to volunteer or do other fun things, and that's great. But he could technically say, no, I want to stop my Social Security. Here's what you paid me, give it back, and have it delay and be higher. But as I got the whole picture, I saw that her Social Security was going to be much higher down the road. And if she, especially, it would be wise for her to delay anyway, because they've done well savings and they've got decent amount saved up and for their plan, and they're not big spenders. Like a lot of
Hmm.
people I meet, they don't need 10,000 or more a month to pay the bills. They a reasonable amount, and they're okay. Things are paid off, and in their case, because her Social Security will be much higher, and typically the women outlive men. Obviously, I won't say because they wear us out or because they knock us off. I'm not going to say that.
Careful, careful, careful.
Yeah, yeah, yeah. Anyway, but so if he did pass away, she keeps her higher Social Security. She's not going to gain anything by him delaying and having a little bit higher, which is still less than hers. And when I looked at their numbers and I started playing with their plan, they've got a decent amount saved up in excess of 3 million. And um, the hard part wasn't necessarily with their on the Social Security side, but the hard part was like 2 million of that three is tax deferred. So they have a $2 million, what I call tax bomb. 1 million of it is Roth, but they don't have a ton just sitting in the bank. So when you look at doing Roth conversions, do you want to reduce that
Mm-hmm.
chunk of money by the tax to convert it to Roth? Typically not. Sometimes it might be okay, but we're still weighing that out, whether it makes sense to do that or not. But normally, let's say you convert 100,000 from your 401k IRA to Roth, you want to pay the tax on that from money like in your checking, savings, CDs from another source, so that you have the full 100,000 to grow tax free in that Roth account. So, but I did see some things. They're still mainly on the stock market, which isn't bad in itself. But the way things are invested, they're on what I might call the Santa Cruz Big Dipper roller coaster. They're on
Yeah.
the fun ride.
Yeah.
So it might be wise to look at how to lower the volatility. Maybe they don't have as high a potential, but by lowering that volatility, that keeps them still with plenty of money throughout retirement, more flexibility because they'll have, more money to grab at, in addition to their income that, will be set. It just gives them more flexibility along the way.
With their Social Security, he's got an okay pension. He's got Social Security. She's going to have savings. I mean, why risk your savings to try to achieve some larger gains when you've won the retirement game? There's no reason for them to take more risk. That doesn't mean completely laying off the bets. That doesn't mean taking everything over to cash.
No, it doesn't mean move it all to cash. No, 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 no. It just, during our accumulation years, up to 5 years before you retire, yeah, go ahead, be more aggressive. But the 5 years before and the 5 years after retirement, especially, we want to be more conservative, protect what you have, and then beyond that, make sure it's going to last. So, yeah, I mean, that's a simple tip out of the Baby Boomer Dilemma movie, which people, if they haven't seen it, just go to our website. There's a 2-minute trailer to it, and you can request the link from us for free to watch it. It's a good movie.
Yeah, and you can see the trailer for that on the website at Soutas.com, Soutas.com, for Dale Soutas, financial advisor right here in California. Take a look at that trailer. We can have you host your own movie event with your spouse, with friends, neighbors, your Friday night poker friends, and invite everybody over. The Baby Boomer Dilemma, and what are some of the concerns? One of the big ones is taxes, and that's why we've been talking so much about taxes today. And even with people's hearts and minds in the right place and trying to do some planning, it is always amazing at small, what they think are factoids that they have absolutely wrong. Another one that somebody who I was talking to recently had said, well, I can't do Roth conversion because I'm not at 59 and a half yet. And it was the same thing we were talking about before. It's like, no, Uncle Sam doesn't care if you pay your taxes sooner.
Oh,
You just have to
Yeah.
do it. You just have to do it properly. But it totally made it was the same thing. It's like, oh no, I can't do a Roth conversion because my money's in the 401k, or it was in the old 401k of rollovers, and it said, yeah, I can't do it until 59 and a half because I can't withdraw the money. I'm like, oh, I get what you're thinking, but that's not based in fact.
Well, plus they might be thinking that if I do conversion before 59 and a half, I still have that 10% penalty. No, you don't, because you're doing a Roth conversion that eliminates the penalty. Yes, you'll pay tax on that conversion, but you won't have a penalty to do it before 59 and a half. So as soon as you can, we want to do that. The other movie on our website, The Power of Zero, really stresses financial education about how to keep Uncle Sam out of your retirement savings. In other words, strategies to, ahead of time, use tax-free, not tax-deferred.
But the thing is and the reason, again, that we're talking about all of this is that so many of us for so very long have been saving tax-deferred. And you want to talk about some of the misinformation. Now, not that this is misinformation. Saving tax-deferred feels good. Saving tax-deferred means, whatever you're putting into your tax-deferred accounts, you don't have to pay on the growth, and you can subtract from whatever your earnings are for that year. The thing is, Dale said a little while ago, is we're in some of the lowest tax brackets across the board in U.S. history right now. So you're going to pay taxes on that stuff eventually, or your heirs are going to. Why not pay it at a controlled tax rate of what you know? Stop the ticking tax time clock on your growth, on your investments, and pay some of those taxes right now. Might sound counterintuitive. You're absolutely right, because we have been taught for 40 years as a country, save tax deferred, save tax deferred. But when you look at real strategies of how you can keep more of your own hard-earned money, one of the things you can do is put a stopper on that tax time clock. That's what Dale is talking about. If you want to know what that would look like for you, your spouse, your retirement plan, even if you're still working right now, that's okay. We can help you with those accounts. We can take a look at it and find out what you're doing, maybe give you some strategies. And if you're in retirement, wouldn't you like to make certain that your money will last as long as you do? Call the phone number. Set up your own free portfolio review with Dale Soutas right now. 833-856-1382. That's 833-856-1382. Or you can go to the website, not only schedule your own time, but take a look at that trailer of The Baby Boomer Dilemma and The Power of Zero. Soutas.com. That's Soutas.com. Soutas.com. More with that man, Dale Soutas, when we get back right after this.
Are you worried about taxes eating into your retirement savings? By engaging in savvy tax planning, you might be able to create greater tax efficiency in your retirement plan. At Soutas Financial, our team of retirement planning specialists can help you explore tax-deferred and tax-free investment options, as well as strategies to help potentially minimize your tax burden in retirement. Don't let taxes derail your retirement plans. Let us help you create a tax-efficient financial plan and work towards maximizing your savings and minimizing your taxes. Call Dale Soutas of Retire Your Way and the team at Soutas Financial today to learn more about our tax planning solutions. Call 833-856-1382. That's 833-856-1382.
You've heard the phrase, you don't know what you don't know, and we believe it's especially true when it comes to retirement planning. There's a lot of information out there, and it can be overwhelming and confusing. So how do you know what you don't know? Social Security, RMDs, estate planning, investment risk. These are just a few of the many areas that a financial advisor can help you navigate. But what else don't you know when it comes to retirement planning? Are you aware of all of the tax implications of your investments? Do you know how to optimize your Social Security benefits? What about your long-term care and estate planning needs? We believe that by working with a retirement planning advisor, you can uncover potential blind spots in your financial plan and gain a better understanding of your options. Don't let unknown factors potentially derail your retirement. Call Dale Soutas of Soutas Financial to uncover what you may not know about your retirement future and start your complimentary written financial plan. 833-856-1382. That's 833-856-1382. Or you can write Dale at dale@soutas.com. That's SOUTAS.com. Welcome back to Retire Your Way with Dale Soutas of Soutas.com, financial advisor. You know, Dale, a lot of time today spent on taxes. We talk a lot about tax returns and how this is sometimes even more important than the investment returns. Why do you spend so much time with this? Why do you spend so much time helping? But you're not a CPA. I don't see you with that little ribbon around your arm and a green visor. And, you know, the little
But you see my
you
abacus,
can
right?
picture it. You knew what I was talking about.
Yeah. Okay, so yeah, it's a good question because when it was finally shown to me, I mean, because years and years for a long time, I always preached what we've all heard, which is throw as much money into your 401ks, your TSPs, your 403bs, whatever, and lower your income taxes today. And when you retire, you take money out and pay less tax on it. But reality is that doesn't happen all the time. In fact, it's very
Why aren't we paying less in tax? Why aren't we paying less in
because
tax?
when people retire,
because we don't have that big salary anymore.
well, you don't have that big salary. I mean, these are all nice theories, but in reality, people still need a decent income to do what they want to do, to pay the bills, to play, all that good stuff. So what do? Besides Social Security, some people still do get pensions, or through the years, they've bought property, they got rental income, okay? But they have all this tax deferred money and they need X amount of dollars out of it to fill in what Social Security doesn't cover. And that pushes more of their Social Security to the taxable column, and it could even push them up higher tax brackets. From 12, it goes to 22, then it goes to 24. So depending on what they need. So reality is, it's kind of like our monthly workshops. We highlight, we were taught to save taxes on roughly $150,000 through the years in retire, while we're working, to ultimately pay tax on over $1 million. And how do people do that? Very simply, do the math. If you start roughly at 35, putting $5,000 of your income into some kind of IRA, TSP, 401k, whatever, and you lower your taxes by $5,000 each year roughly through age 64, let's say, that's $150,000 that went into that tax deferred account. You didn't pay tax on that $150,000. And let's say you average 7% growth on that through the years. That account at age 65 is worth over $500,000. You only put 150 in, but it's worth $500,000 or more. Now, down the road, you have to start taking a minimum out. And for most, right now, it's age 73. For those born in 1960 and after, you have to start taking a minimum out of that account, whether you need it, want it, or not, at 75. So 73, roughly in your 70s, you got to start taking something out, because Uncle Sam wants to get the taxes on it. So now that's grown, and you delay till 70. Now that's worth $600,000-$700,000. You start taking your minimums, which you got $700,000. That could be, realistically, what? My head's not working. But anyway, you take out money, and if you live through about 85, 90, you've taken out $500,000-$600,000 over those years. You paid tax on it when you took it out, and now there's still another $500,000 or $600,000 left over to either your spouse or to your kids and grandkids, beneficiaries. And so you save tax on $150,000 for Uncle Sam to ultimately get taxes on over $1 million of your money. So what the Power of Zero movie emphasizes is, if you're going to start saving for your future, put after-tax money, $5,000 a year, into like a Roth or a properly structured life insurance. Have that grow. Now at 65, you still have $500,000 or more. And when in retirement, you don't have to take anything out of it if you don't want to. But if you do, out of that $500,000, $600,000, $700,000, as you take it out, it's tax-free. And if you die and you leave $500,000, $600,000 or more to your spouse or kids, it's tax-free to them. So why, it's better to pay tax on $150,000 than to pay tax on over $1 million, like we were taught. So, those are some of the things we talk about. every month
Mm-hmm.
in our workshop at Fresno State. And people are welcome to come, and maybe you have friends, coworkers, whatever, that you'd like to introduce to us or have them understand, or
Yeah.
with you. Just sign up on our website. We have them, like I said, every month, free of charge. Next month we'll charge double. Let's see, 2 times 0. I can't remember what that is now.
I am on your website right now.
Uh-huh.
And folks at Soutas.com, look at his handsome face there. There's Dale Soutas. Nice bright yellow shirt there. If you want to
That's why
know
you screamed, huh?
when yeah, that's why I had to hit mute over here. At Soutas.com, go to Soutas.com. If you want to come to one of the live events, all you have to do, register at the website. Go register at the website. There's no cost to come in, but we do have limited seating. So we want to make sure that you get registered. You can come with your spouse. You can come with your sweetheart. You can come with both of them. I'm kidding. You can come with your friends, your neighbors, your neighbors. Come with who you want to, but make sure that you register at the website so we've got a seat for you when you show up. You do most of these at Fresno University at the Business Center. All of you should know where. You can always just Google that, or eventually you can call the phone number. In fact, I'm looking at the website. There's a good old-fashioned phone icon on the upper right. You have any questions, call that number. I'll give you ours here from the radio show in a moment.
Yeah.
We have every single one of the dates. I'm looking, oh my gosh, all the way out through December right now.
Well, if you look, you click the event button, and I didn't know this until they showed me, and you scroll down with your cursor down to the very next workshop. It turns blue. You click on it, and it will come up as Retire Your Way. It'll show you actually a map, how to find exactly where we'll be, and you can register right there. So it makes I'm amazed at how easy they made it.
Totally free. We can talk about your tax questions. Yeah, we talk about estate planning, whatever's on your mind. You can ask questions until Dale is completely wiped out at the end. We bring a lot of the team. It isn't just Dale. It really does take a village. We've got folks who help answer your questions, find out the information. But Dale, with his, can we say, 4 decades of experience with insurance and all the different long-term care rules here in the state of California, both good and bad. It changes sometimes from county to county. With all the tax changes over the decades, with all of the ways that the market has become more volatile and changes in interest rates, come to one of the live events so we can make that contact with you. Now, when you look on the website, you're going to see all these different dates there. If you are worried about what I started to open up today's program with, are we in a financial reset here in the United States? We're seeing our markets compressed by about 8 or 9%. Interest rates will likely change before the end of the year. I just think there's a lot of uncertainty. It's the best way I can phrase a lot of uncertainty. And if that's making you feel angsty, if that's keeping you up at night, if your sweetheart is looking at you and saying, are we going to be okay? Are we all right? And you don't know for certain the answer to that question, call the phone number, set up a time, or go to Soutas.com, come to one of the live events. Here's the phone number, folks, 833-856-1382. That's 833-856-1382. The website is Soutas.com, Soutas.com. And click on, there's an orange icon there in the middle, and click on it and scroll down. You'll see events. It's pretty simple. Swing yourself all around the website. There's what we were talking about before. There's the movie trailers. There's a little bit about Dale. We're going to have, we've got some new videos that Dale and I are putting together, all kinds of information there. Dale, you were impressed with your own website. Clearly, you've got a team helping you with a website.
Oh, I
You
know.
didn't know
Well,
how
they
easy it
just
was.
recently adjusted it. I was saying, how come we can't just click on it and go to the registration page? And they said, no, it's already there. And I go, oh.
Yeah,
Because
it's all right there.
just
for
call
you.
me Mr. Technology. Plus, previous radio shows are right there, Retire Your Way podcast.
Yeah.
There's
If you're missing information, or if you travel, or if you're not able to sit for a full hour, which a lot of folks don't. I mean, we know this in the radio industry. You might be able to listen to us to 8, 9, 10 minutes at a time. If you want to hear previous broadcasts, or if the sound of Dale's voice talking about retirement plans helps you relax and you like to hear what the philosophies
puts you
are.
to sleep.
Well, no, it just helps you relax and feel better that somebody is watching this for you. Folks, in retirement, you don't want to have to white knuckle your hands on the steering wheel of your finances. I know you're doing that right now to drive around and do your errands, but you don't want to have to worry about the ups and downs of the market. And if you'd like to have somebody help you with it, do your own portfolio review, your income review, your tax review, your long-term care review at no cost to you. It's so simple. Call this phone number right now. We're going to have folks standing by, even though that's all the time we have today. Or you can go to the website where there is a wealth of literal information there for you. 833-856-1382 is the phone number, and Soutas.com is the website, Soutas.com. For Dale Soutas and his entire team here to help you, I'm Spike. He and I will both be back again next week. Will I run out of money in retirement? That's a hard question to answer if you've never been retired. How do you grow your investments without taking too much risk, but also considering what you'll pay in taxes? Should you convert your tax-deferred accounts into Roth accounts for tax-free growth later? Don't forget about inflation. Instead of questions about your retirement, turn to answers and solutions. Call and ask for your own complimentary retirement solution review. 833-856-1382 for your complimentary retirement solution review. Comments regarding a particular client's experiences and outcomes may or may not be the same as another client's experience and could differ substantially, and is not an indication that any client or prospective client will experience the same or a higher level of future success or performance. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and estate/legacy planning strategies with your legal/tax advisor to be sure a Roth IRA conversion fits into your planning strategies. This is not endorsed or affiliated with the Social Security Administration or any U.S. government agency.
Investment advisory services are offered through Foundations Investment Advisors, LLC, Foundations, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any discussions of specific strategies are for informational purposes only and have been provided to help determine whether they may be appropriate for your specific situation. If applicable, the primary goal is converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. Each individual investor's situation is different, and any ideas provided may not be appropriate for your particular circumstances. Comments regarding a particular client's experience may or may not be the same as another client's experience and is not an indication that any client or prospective client will experience the same or a higher level of future success or performance. Foundations only transacts business in those jurisdictions where it's properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Nothing herein constitutes a recommendation that any security, portfolio, or securities or investment strategy is suitable for any specific person. No legal or tax advice is provided. Please review your retirement, tax, and estate legacy planning strategies with a legal tax professional before transacting or implementing any strategies discussed herein. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not in any way refer to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. This is not endorsed or affiliated with the Social Security Administration, any federal Medicare program, nor any U.S. government agency. If applicable, we do not offer every plan available in your area, and contacting us at the phone numbers provided herein will direct you to a licensed insurance agent. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all your options. All rights reserved.